this is going to be a quick one, and it was from Lance. He says, Lance had emailed me a question earlier today, and he says, can you go over some of the rules, concepts, or thoughts, excuse me, folks, regarding using a married put position on a low price stock 30 to 45 days out in time? Well, it's not what we do, of course. The married put we recommend is that we're going to go ahead and use a put option that is far out in time, usually is 5-6 months out in time, and slightly in the money. And the reason why we do that is because it takes advantage of the 3 core principles of really any trading, following the at-the-money bell curve, of course, proper position sizing, and the radioactive decay line. The shorter-term options tend to trend downward. The shorter-term options, you tend to lose whatever time value you had more rapidly, as a percentage-wise, of course, compared to other positions. Well, Lance said, along those lines, a question, going over considerations when looking for married put candidates for lower price stocks in a shorter time frame, say 30 to 45 days, like ZNGA. Okay, so let's just go into ZNGA. And let's just take, I believe July 2nd is in that time frame. The weekly for July 2nd is in that time frame. And let's just look at the married puts that are available. Okay, so this is just the more results. Now, one thing that you notice here is that in a normal time frame and in a normal structure, what we would expect to see, and I might go short another month, we'd expect to see a linear numeric regression, meaning the highest strike put, the 10 put, would be up top, followed by that 9.5 and the 8.5, I'm sorry, then the 9 and then the 8.5 and so forth. This is all jumbled up. Why? And it's because the bid-ask spreads are so wide and the midpoints are so off-priced because of that, that what you're seeing here is you should normally start deep in the money with the lowest risk, which isn't the best, and the out of the money with the highest risk as well. But this is all over the map because of these wide bid-ask spreads. Okay, so let's go to another month and see if that, another week I should say, let's go to June 26 and see if that clears this up a little bit. Okay, it's still the same. It's all jumbled where it should be straightforward numbers. Let me just go back to June 5th here as well. Okay, so this is closer. But look at this, a bid of 5 cents and an ask of 4.25, so it gets a skewed bid-ask spread that's sort of out of bounds compared to the other ones. So number one, that's a problem you're going to face. Number two, as I mentioned earlier, we tend to go a couple strikes in the money to look for the proper risk on the position. Let's just go to June 19th. It's not 30 days out as you wanted, but it's 28. And so when you're looking at these positions, there's still 3, 4, 5, 6% risk for 30 days out in time because of the higher volatility, 0.7, 0.6. It's not out of bounds, but they're higher price positions. So Lance, there really is no guidance I can give you on this because I don't trade this way. And I don't do this. Most people would say that you want to take the higher risk and pay the cheaper price and go with the out of the money. Here's Zinc at 838, so you're probably looking at this price. Knowing that you're expecting to essentially throw all this away, you're going to watch that time decay evaporate very quickly. But what you're protecting against is just something, a 20, 30, 40% drop on the position. Now, I'd be tempted to go with the 9 strike or the 8.5 per our usual radioactive trading structure. It's going to be more expensive, but we're going to take on a lower risk. But we have such a short time frame for the stock to move in our desired direction to hit the break even that it might not be worth it. See, in the married put position that we structure, when we go 5 or 6 months out in time, I don't typically pay attention to the total net debit or the break even price because that's 200 days away. And I know that if my stock moves up 1 or 2%, I'm going to be at a half or 1 or 1.5% gain in the next 20 to 30 days. Here already, you're adding 4 or 5% to the cost of the position. So you need a 4 or 5% move in 30 to 45 days in order to get to break even. Okay, so that's why I'd say that most investors who would talk about doing a short-term married put 30 to 45 days, they're looking to take the higher risk to go further out of the money, expecting to sort of throw the cost away on the premium because they know it's going to evaporate to zero as well. Okay, all right, so that's really all the thoughts I have on it, Lance. You're probably going to be focusing on out of the money for the higher risk and the lower cost, because going with the standard structure we would use for the single-digit protection, you don't have enough time, I think, for the stock to move in your desired direction to see a reasonable profit on the position. And that's one of the reasons why I don't use shorter-term married puts, even if they're on lower price stocks. You're still taking a 14, 15, 16% risk with the out-of-the-money options. But what you're just protecting against is a, sudden decline of maybe 20 or 30% in that case. All right, so that was for Lance. Frank, great question. I think we covered this a little bit last week. I just put up some of the ones today. I can't remember who asked the question, but I have it right in front of me, don't I? It was Glenn, I think, last week asked the question about why do married puts, why not do a covered call? Okay, but you brought up the point here, and you said, is that true with covered calls? Well, what's true with I don't know exactly what you mean is what part of this, Frank, is true. But the same concept of covered calls can be applied to what we just talked about with the spreads. It's not the same. Oh, geez, covered call. I'm sorry here. You said 50%. Oh, no. On a covered call position, what did we see? Let me take a pause here and take a step back, Frank. What did we see about 20 minutes ago with the diagonal spreads, which also applies to the bull put credit spreads? If I have a 10% drop in the stock, the diagonal spreads we were looking at a little while ago, we saw some things that were close to a 40 or 50% loss of what was invested. Okay? Whereas with the covered call position, if you have a 10% decline in the stock, you keep the premium, you're fully invested in the position, so you're only down 7%. So you said, is that true of the covered call that you should look for the 50%? No. In general, most investors I talk to will usually look to close out the covered call position if it's dropped 10% or so. A popular IBD stock list, I believe, William O'Neill, excuse me, Bill O'Neill, William O'Neill, his stops he always set, and he taught for IBD and all their products and all their webinars and such and inline seminars, I believe was 7%. He would teach investors to close out of their stock positions, i.e. even the covered call positions, if the stocks fell 7%. Time to get out and time to look for a new position. That's a general rule, of course. You can manage over time. What I see true about covered calls is that when I do maybe a slightly in-the-money covered call for protection, I'm probably talking about a 3, maybe 3.5% return if assigned. And of course, yeah, we're going to set our loss at around 7%. We're not going to have an 85% success rate, though. To get that 3.5% return if assigned, what we're going to have to be is sort of slightly in the money. So we're probably going to be at a 70%, 75% success rate. And again, we'll take $10,000, but let's split it up 50-50. So we're deploying $5,000 into each position. 68% success rate doesn't get it. I'm still losing money long term. I went up about 10% over time during those 100 trades. It happened here actually in the 7th trade, but over time, I need to be right more often. If I'm making 3% when I'm right, limiting it to 7% when I'm wrong. Okay? 70-30. That's not it, is it? We're not even breaking even. We're just below break even in that case. So you can imagine what a covered call would look like if you allowed a 50% loss. Let's go, I'm going to take this up to 25. I think you need to be right 75% of the, 72% of the time to get what you'd expect. There's 77, okay. Let's say you did, here's a 77% success rate. You're trading covered calls. Let's say you do 3 covered calls. Well, let's say you do, 3 covered calls. You do weekly covered calls. Do weekly covered calls. You do 3 covered calls per week. So over the course of 4 weeks, we've got 12 positions. Over 12 months, that's 144 trades. Okay, so let's scale that back a little bit. Let's just go every 2 weeks. We'll do 2 positions. Okay, so every month we've got 4 trades times the 52. There we go. I'm sorry, yeah, times 28. But in any case, after 100 trades, being right 77% of the time, depending on if you're doing weekly. If you're doing monthly and you're doing 4 trades, naturally you're going to get 48 trades per month. So to get to 100 trades, it'd take you 2 years. And at a 77% success rate with these numbers, you see that you'd be up about 40%, averaging 20% per year. That's logical for a covered call position, in my opinion. Okay, 20%, 21% per year, 25% per year, that's close. The people who say 36% per year are exaggerating. I mean, there's someone out there who used to teach that you could make 3 to 6% per month with covered calls, and if the stock falls, don't worry about it. You don't care about it. Just keep writing. Just keep writing. Oh, no, I absolutely care about it. If my stock falls 35%, number one, I'm not getting 3 to 6% anymore, and anything that I'm selling at that point, at that low, if the stock recovers, I'm getting assigned for a 25, 28, 30% loss on the position. Okay, but I'm trying to illustrate that if you set a target that, hey, a good reasonable return for covered calls is 3%, I'm going to follow the Bill O'Neill rule and get out when I'm at a 7% loss in the position. I'm going to expect to be right 75% of the time. Hopefully you've got good stock picking. You're going slightly in the money, but the deeper in the money you go for the higher probability, you're going to lower that return down. Okay, and you split your money, and this is what you'd expect. Why is this so? Why am I spending time on this? Because two things. If you go to a 74% win ratio, you're right 74% of the time, you might only make 20% over 2 years. If you're doing 48 trades per year, you might make 20%. That's about 10% per year. Again, not bad. But this reemphasizes what your expectations should be and how a simple change of the dial of win ratio can greatly affect a covered call structure. Remember, the covered call structure caps your winners and allows your losers to run. Okay, so this is hopeful. This means that one of those stocks that falls 15% overnight, you might actually be at a 12, 10, maybe even close to a 14% loss on that position, not 7, okay, in that case. So that's why it's different. Now, notice here, of course, we're on the RadioActive Trading site, which is where we teach and promote the education of the limited risk married put strategy, which is a covered call flipped on its side. And what we mean by that is that you leave the upside open, so you can expect closer to 6.5%, 7% on your winners, and you're guaranteed not to lose more than 4, 5, or 6% on your losers. And I can even set this at 50-50. And there you go. 52 win ratio over 100 trades, I've doubled my money. Because this is guaranteed never to lose more because of the proper structure, and you can get more upside because you haven't capped the gain as you would with the covered call position. That's why this tool is here, is to illustrate sort of what the expectations would be on a married put position long term, without even considering the income methods versus a covered call structure. We love to get income, but remember the structure of the trade. It's designed to cap your winners to a certain percentage, but allow the losers to run. And the covered call strategy can come back to hurt you long term, especially in various markets. Now, it said, Donald says, on these covered calls, you're doing buy rates. Essentially, that's what I'm referring to in this sort of example. And going back to what we show on the covered call screen for the picks of the day that we talked about before too, you're buying the stock and selling a call right away, and you're not planning on any management. You're hoping to get assigned, take the return, and move on to the next position, not continually sell a sort of out-of-the-money covered call on a stock you want to hold long-term because you're trying to duplicate or mimic a dividend-like income. Okay, so when I'm talking about those covered calls and the numbers that we put in here, I'm assuming no management. We're assuming that you're doing the buy right just to get assigned, take the 3% profit if you got assigned on the covered call, stop and liquidate the whole thing if you took a 7% loss on the position, to compare to other numerical structures that we looked at as well. Have fun with it this weekend. Sorry about that. You can go to RadioActiveTrading.com, and as you saw, just click on the Resources tab, and then click on the Trade Simulator tool. That's what I wanted to do there. Sorry. And I'll send it to everyone in the chat. So what I want you to do is, if you have time this weekend, of course, go ahead and play around with that. Just go to RadioActiveTrading.com, click on the Resources tab, and then click on the Trade Simulator. What are your returns been? Percentage-wise return on average over your last 50 trades in a given strategy. Sorry about that. What are your losers when you had to close out the position when your triggers were hit? And what was your win-loss ratio? Plug that in and see after 100 trades, what do you expect profit-wise? And you can add the commissions in as well. If you want to, you can add the stock commission or option commission and the number of option trades if you're doing a different strategy there, if you want to start to account for those as well. Okay, Maurice, I thought I had talked to you about this when you talked on the phone. RadioActiveTrading.com. This was the original site developed by Kurt Frankenberg, who, of course, is the original author of the Blueprint. The Blueprint and RadioActiveTrading.com focuses only on the married put structure we were just discussing that flips the covered call on its end, where I'm buying a stock, but instead of selling the call right away, I'm buying a put right away with the proper structure based on the rules in the Blueprint. So on any position, I'm guaranteed a maximum risk of 5-6%, single digits, okay? Better than a stop order. See, if I'm in a covered call, let's say I'm in a covered call on Skyworks, and we were looking at the bull put spread too, but let's say Skyworks falls 15% over the weekend before Tuesday's open. Remember, Mondays, markets closes on Monday, folks. We get that extra day. But okay, Skyworks falls 15%. If I enter that covered call on Skyworks and I put in a 7% stop order, all that is a market order saying to my broker, hey, if it's ever below this price, close it out for what price you can get. So I put a 7% stop order following the ideas of the stops we just talked about. It gaps down 15% in pre-market and opens Monday before any trades can happen, 15% lower. Where do I get filled? Not at 7%. I get filled at 15%. That's all the market can give me. They can't go back in time and get the better price. I'm filled at a 15% loss in the position. And we saw already using that trade simulator tool how tricky it was and how affected it was by even using a 7% loss when we've capped our gains to 3% without the management. So the RadioActiveTrading.com, the married put structure, flips, let's go back over here real quick, flips the covered call on its side. The put gives me a guaranteed exit where I can't lose more than 4 or 5%, and this is the worst case scenario. I'll expand on that in just one moment. But I leave the upside open instead of having a capped gain as a covered call. And if I want to stay in the stock, I have to buy this back and add more to my cost basis, roll to a higher strike. And if I want to roll for a credit, I may have to go 4 or 5 months out because I'm paying more to buy this back. This is going up. Yes, my put's losing value, but I still have a positive delta structure. That's the radioactive trading technique, this initial setup, and then we use the 12 different preferred income methods, some of which we talked about at the beginning of the presentation, to lower this initial at risk, potentially bulletproof the trades so we have no risk, and still unlimited upside profit potential. RadioActiveTrading.com is the education wing. This is where we have free webinars, blogs, information on the limited risk trading strategy, and the sketch, the free white paper. You guys can check that out. Just go here, put in your name and email address, and you'll get a free 9-page white paper via email that discusses the introduction to the married put structure. Okay, I'm sorry. I mentioned that's what RadioActiveTrading.com is. For Blueprint owners, there's other members-only presentations that they can access here, and there's a subscription called Fusion. And the Fusion subscription, well, let me go back here for a moment. Let me do it this way, Maurice. It's probably better. The Fusion subscription, when an investor purchases the Blueprint, we have a service here called Fusion. And what the Fusion subscription does, it includes lessons to help sort of expand on the lessons in that full educational course, the Blueprint, to learn the married put radioactive trading techniques. There is a basic search here for radioactive trades, RPMs, the married put, the starting point, but it's the same that's on power options. And let's see if it pulls up here. And then, of course, you see that there's, for Fusion subscribers to this site, there's members-only webinars and white papers as well as Blueprint owners. They're different. If you buy the Blueprint, you have access to all of the Blueprint pod information here. But if you're a Fusion subscriber, you have access to this. Now, this is the same trades we would see on the married put search on power options, Maurice. Okay, but this is just another tool to use for those that are following the Blueprint and continuing their education. There's also the open trades. This is showing you the current positions that Ernie and I have open following the radioactive trading technique approach. Okay. I thought Ernie had a bulletproof position. I guess he doesn't. Oh, he does. Oh, that's interesting. This Abbott Labs appears to be a bulletproof trade. Usually it's highlighted to show that it's bulletproof, but his is not. I had one that was bulletproof that I closed last week. The stock was down, I think, 22% when I closed it. We made a profit of 1.9% on the position. Okay. Yeah, so that's what's available. That's what RadioActive Trading is, Maurice, and that's what the Fusion subscription is. And it's mainly, the Fusion subscription I'm talking about is mainly for blueprint owners who want to continue their education and master sort of the skills that are talked about in the educational course for applying the strategy and this technique. Power Options owns RadioActive Trading. Okay, we purchased the rights to RadioActive Trading when we started working with Kurt in 2008 and 2009. And as well, and I've been trading, of course, the married put technique with 50% of my portfolio since 2008. We reviewed that a little bit last week. Was it Wes? No, it wasn't Wesley. No, it was Wesley. I'm sorry, I forget. Someone asked me to go over the, oh, it was William. I'm sorry, it was William. It was to go over the Fusion track record and show and elaborate on some of your best trades and some of your worst trades. And the first trade, of course, was the Office max trade, or what we call the Office min trade, which declined 30 to 40%. I think it was 50% actually when I was in the position, and we ended up with a profit of, I think, 3 or 4% on the trade using the RadioActive Trading techniques as well. Okay, so last but not least, real quick here, I wanted to talk about the question we were just going through. I had mentioned that we're flipping the covered call on its end. Right? The proper structure that we use, going far out in time to apply the 3 core principles of radioactive trading. We're buying the stock and buying the put so that in the worst case scenario, we're not going to lose more than single digits, the maximum risk on the position. Let's take Autodesk here. It's an expensive stock, but that's okay. I'm just going to use it as an example. So at midpoint, I might go for lower risk here. This is buying the stock at 195 and buying the 220. Whew, that's pretty expensive. I mean, it's pretty volatile. This is really high. I'd expect the 210 to maybe be at that price, not the 220. In any case, all right, so here's what I was talking about. The worst case scenario, if I hold the position all the way to January expiration, I make no adjustments. I do none of the 12 income methods, and if Autodesk pays the dividend, I refuse to take payment of the dividend. The worst I can do is lose 7.1%. This curved line here is showing you the profit and loss at the halfway point. Right? So we're buying an expensive far out in time put, and the reason why is that, look, at the halfway point at September, I don't need the stock to go up to the break even. This is why I said at the beginning of the presentation, I don't pay attention to the break even when I do the radioactive positions, because that's if and only if I hold the position all the way to expiration. Make no adjustments except no dividends if my stock pays a dividend. At the halfway point, I might need the stock only be trading about 210 to 11 to break even. But what about 30 days from now? Okay, what about in 1 month? What if the stock stays at that price to June 22nd? Okay, we assume volatility stays about the same. Now remember, my maximum risk is 1690. If in the first 30 days, even if the stock doesn't move, I've only lost about $160 on that put, a tenth of the maximum risk. That single-digit maximum risk I was talking about only occurs at the far-term expiration. Okay? One quick thing I always like to show here, what's also fascinating about this? Let's call it 170. This far out in time, deep in the money married put structure carries a risk of 7.1%. And if the stock doesn't move in the first 30 days, the volatility stays where it is, I'm only losing $170. I mean, that sounds expensive, but remember, we paid $41 for this. So we're losing a fair amount of time premium, sure, but it's only down 170. Earlier in the presentation, Lance had asked about the shorter term 30 to 45 day out married puts on low price stocks, and did I have any sort of comments or guidance on that? And I said I really didn't, and I'd say you'd probably be going out of the money, because if you go in the money like we're doing here, longer term, more time for the stock to move in our desired direction. But if I'm keeping it that short term, I'm probably going out of the money for a cheaper price. Let's take a look at Autodesk. Remember, $1.70 in 30 days, June 22nd. We'll have to go to June 26th. Where is the closest put? Where's the put that's $1.70? It's wide bid-ask spreads. All right, let's just take the 165. It's going to be more than $1.70. Why am I showing this? Because look, what do I expect to happen in the shorter term if this, okay, this is 301 anyway, but in the shorter term, what do I expect to happen if the stock stays at the same price to June 22nd? I'm going to lose all $300. I'm going to lose the full value that I paid in the position. Oh, it's because I had to go so low, we're at a 17% risk instead of a 7. This becomes more important. If I want to control risk even shorter term, we have to go closer to at the money. Let's go with the 190. Okay. Now, I'm paying $9.18. There's a good risk. Equal amount of risk to what I had on the January more expensive 220 strike put. 7.1% risk for the December or January put on Autodesk versus 7.3% for a 1 month out 190 put that cost $9. And what, remember, if the stock stays at the same price between now and June 22nd, and volatility stays about the same, I'm going to be losing, it's still 4 days to expiration, so it's leaving me $1.77, but we're going to lose $740 of what we paid on this put. On the proper radioactive married put structure, same time frame, no change in the stock price, I've only lost $170. I'm probably not even at a 1% loss on that position. Here I'm at 7%. That's sort of the reason why we don't advocate using the 1 month out put options, because you don't get the proper structure and you usually end up losing more of the cost of the put. It is a fifth the cost of the December put that I'm buying, or the January put that I was buying on Autodesk. But I'm getting 7 times the amount of time for the stock to move in my direction. And one of the core principles, naturally the time decay curve of an option, shows us what? That you expect, this is 30 days. This is 15 days. This is 60 days. This is a 90. This is 120. And this is 150. So if I'm buying in options that are 200 and 150 days out in time, I have a much slower time decay, and we just proved that. I'd lose likely $170 of that $40 I paid for that December 220 put in the first month if the stock didn't move, versus losing $750 using that cheaper 30-day output. It's a bigger loss, and I'm already at the 7% maximum loss on the trade. By structuring it properly, going further out in time, I've only lost 170. I'm probably not even down 1% on the entire position. Okay, so that's just sort of a little bit more insight into why we're doing it the way we're doing. But as I mentioned before, you can go to RadioActiveTrading.com this weekend, and you can go ahead and just go to the main site, excuse me. Oh, I got to sign out. I'm sorry. There we go. Put your name and email address and click Get the Sketch. We'll email you the free 9-page white paper which introduces these concepts of the limited risk trading and the benefits of the limited risk trading concept. The full work is in the blueprint, and you can also come here for the free resources and check out the trade simulator tool there as well to play around with your numbers to see if you're expecting to be profitable long term with your wins, your number of wins, and the probability of loss ratio, and of course your target price when you're right, your average winning value when you're right, and your average losing value when you're wrong.